Hey, what's up you guys? Welcome to another episode of Investing with Kurt. If you're new here landing on my video for the first time, we talk about real investing advice on this channel. We avoid trading and we avoid speculating. We're following the Boglehead's philosophy of simple, long-term passive investing. Today, I want to discuss Warren Buffett's speech at the 2020 Berkshire Hathaway shareholders meeting last weekend. I want to focus on one specific topic, which I believe is the most important for regular investors, beginner investors or more experienced investors, regular people like you and me. And that topic was what he thinks about index fund investing or the so-called passive investing. I'll show you two specific bits of his speech. While listening to those excerpts, I'll provide you my commentary and my explanation of what that practically means, whatever he's saying. And at the end of the episode, I'll give you the funds and the tickers you can use if you want to follow Buffett's advice for investing. So let's get started. Alright, so the whole conference was broadcasted by Yahoo Finance, and you can watch the whole video if you want, but I'm just going to focus your attention to two specific segments of the video. So let's start with the first part here.
Not think if you own a great many businesses that everyone is destined for success. That's why I suggest to people they buy an index fund. I do not, with the exception of Berkshire, I would not want to put all my money in any one company, although there's a few I wouldn't mind being very close to that. But I don't think, you get surprises in this world, and there will be businesses that we think are very good that turn out not to be so good, and there will be other businesses that turn out better than we think, and it's up to the world to judge our batting average over time.
All right, so not every business is destined for success, and this is why Buffett advises that people buy an index fund, since you don't have to guess which business will succeed. He says, I wouldn't want to put all my money in one single company. And this is what we've been advising here on this channel as well. You don't want to be putting all your money in one basket. That is, you don't want to buy a single stock. You don't want to buy a single company, because this is very risky. Even if we talk about a single industry or sector, let's take the airlines, for example. They've been absolutely crushed. So you don't want to be taking that risk. Rather, you want to be diversifying away from owning a single company or a single stock and buy a whole bunch of companies in one single index fund. A couple of minutes later in the video, there is a question from one of the shareholders asking Buffett directly about indexing and whether passive investing is a bad strategy. So as a bit of a background, there's been quite a few active managers lately that have spoken badly about indexing. Obviously, they do not like that because it is not in their interest. As active managers, they want people to buy their active funds. But those individuals have been making some public comments and statements and writing articles such as index funds are a bubble or stay away from index funds. Let's hear how Buffett responds to that.
Warren, a moment ago you mentioned that you still are recommending that people invest in an S&P 500 index fund. Let me ask this question that came in from Kevin. He says, the last few weeks we've been hearing from active money managers that the day of passive investing is over. The historical safety of investing in an index fund long-term is gone. Would you please provide your thoughts on this topic, particularly in regards to an investment time span of 10 years?
Well, I can tell you I haven't changed my will, and it directs that my widow would have 90% of the funds in index funds, and I think it's better advice than people are generally getting from people that are getting paid a lot to give other advice. You don't make a lot of money advising an S&P 500 index fund. I mean,
the very first point he makes, and this has been common knowledge, that he has instructed his family to invest the majority of the money he leaves behind in the S&P 500 index. And he particularly likes the S&P 500 that Vanguard offers. So he's confirming that in this video, that he still believes this will be the best utilization of the wealth he has accumulated.
how you can say the day of index funds is over. I mean, if you say the day of investing in America is over, I would disagree quite violently. And then is there something special about index funds being a terrible way to invest? I just don't think it's very hard to have evidence of that. I mean, if the index funds reflect the market, and one side has high fees, that
All right, so before we continue any further, so this is the point I really want to stress, that he really debunks the idea of index funds being a terrible way to invest. To him, this is a way to hold the total stock market or a cross-section of America. That cannot be a bad decision. It's synonymous in a way to say that investing in a stock market is a bad idea. And he is a big proponent of investing in the stock market. So he continues now to really provide arguments why active managers are not being truthful when they're criticizing index fund investing.
that think they can pick out stocks, and the other side has low fees. I know which side's going to win over time, and you have to recognize that it's in a great many people's interest to convince you that they can do something that they may well even believe they can, and a certain percentage of them will do it from luck, and a few people will do it from skill, and that's what makes it so enticing that you can find the Jim Simons or somebody that's going to produce extraordinary return.
All right, so he really continues in a very polite way actually to explain that these kinds of active fund managers are great salesmen and they have no interest in actually selling passive index funds such as the S&P 500. So for them to make money, they need to be trading. They need to be switching people in and out of particular funds. They need to be picking different strategies to address the market volatility. And this is how they excite people. This is how money managers make money off of the fees they charge when they're conducting transactions, when they're managing your money. That could also be a yearly management fee as a percentage of the total amount they are managing for their clients.
And Jim and his group have done it by brain power, but it's very unusual. And incidentally, they're going to charge you a lot of money, and they're going to actually maybe close up their fund if they do it, because they can't do it with really huge amounts of money compared to how the record's been established in the past. So.
And the other point, I'm not sure if you picked up on that also, I want to really, really stress this point, is that the major point about actively managed funds is the fact that there is significantly higher in cost compared to passive investing. Because passive index funds, let's say you want to hold the S&P 500 index, that will cost you about 3 basis points or 0.03%. That's a very, very small amount. But if you invest in actively managed funds, they usually charge on average anywhere around 1% of an annual fee or even higher, 1.5%. Some of them may have a load fee where in order for you to start investing in that fund, you need to pay an upfront charge. Some of them may have an exit fee. If you want to cash out, you also have to pay some commissions. So overall, even if you compare the S&P 500 and actively managed fund, even if the actively managed fund manages by any chance to outperform the S&P 500 for a particular year, when you factor in costs and the fees they charge, you'll be better off simply investing in the S&P 500 because net you'll have a higher rate of return.
You just have to recognize you're dealing with an industry where it pays to be a great salesperson, and it pays even better if you're a great salesperson and you can actually produce something. But the money is in selling. There's a lot more money in selling than in managing, actually, if you look to the essence of investment management.
And by the way, if you haven't seen my video on active versus passive investing, I'll link to it in the description of this episode, so make sure to check that out, because in that video, I actually discuss what academia is advising us to do. That is to stick to passive investing due to costs. And I think it's really interesting if you listen to what Buffett is saying, and if you listen to what the academics are preaching to us, it seems like they're kind of singing the same song, which is all about buying broad index funds and eliminating the cost of active fund managers.
I got a number of variations on this next question, some more polite than others. This one's right about down the middle. But this is from Mark Blakely, who writes in from Tulsa, Oklahoma, and he says, like many, I'm a proud Berkshire Hathaway shareholder. However, in comparing the performance of Berkshire with the S&P 500 over the last 5, 10, or 15 years, I've been disappointed in Berkshire's underperformance. Even year to date, Berkshire is trailing the S&P 500 by 8%. To what would you attribute Berkshire's underperformance? Well, I can't imagine ever selling my Berkshire stock. At some point, money is money.
So one more follow-up question on this topic of indexing. Buffett's company has been, producing amazing returns for a long time, and they have a great track record of great returns. However, in the recent years, they've been doing poorly, and fact of the matter is they've been doing worse than the S&P 500. So Buffett's being really cornered here by one of the shareholders with this direct question of when is actually Berkshire Hathaway going to be at least on par with the S&P 500? And let's take a listen of how Buffett addresses this question.
Well, I agree with everything that I forget his name, but said. I mean, the truth is that I recommend the S&P 500 to people, and I happen to believe that Berkshire is about as sound as any single investment can be in terms of earning reasonable returns over time. But I would not want to bet my life on whether we beat the S&P 500 over the next 10 years. I think I obviously think there's a reasonable chance of doing it,
So Buffett openly admits that they may not be able to beat the S&P 500. And this is very logical because, in essence, Berkshire Hathaway, and let me oversimplify it here, but it's almost like they're an actively managed fund. And they own a few businesses and bet on the fact that those businesses will produce. So if you're buying Berkshire Hathaway, it's almost like you're buying an actively managed fund. And that is different than owning the S&P 500 or the total stock market, in which case you're betting on all of America to produce. That's quite different.
We've had periods, I don't know how many out of the 50, 55 years we've been doing it, or I don't know how many we've beaten or not. I mentioned earlier that 1954 was my best year, but I was working absolutely with peanuts, unfortunately. And I think if you work with small sums of money, I think there is some chance of a few people that really do bring something to the game. But I think it's very, very hard for anybody to identify them.
Now pay attention to his choice of words here. He says some chances of, or a very few people to pick out some winning stocks. But it's very, very hard to identify those people. So, he already paints the picture that it's really tough, and that he earlier mentioned that also you need a little bit of luck, not only the brain power of smart managers, but you need quite a bit of luck as well. So if it's so few people can do it, and if it's very, very hard to identify those people, and if you actually need a little bit of luck and the brain power, then we're talking about a whole bunch of variables here that come into play to pick out individual stocks. But let's continue listening.
I think that when they work with large funds, it gets tougher. And it's certainly gotten tougher for us with larger funds. And I would make no promise to anybody that we will do better than the S&P 500. But what I will.
So there's another condition. He says, if you're managing a big chunk of money, then it becomes even tougher. So not only do you have to pick out the winning stocks, not only it's very, very hard, not only it's a few people that can do it, but also to do it with small amount of money, then it becomes almost like a mission impossible, in my opinion, to pick out the winning stocks.
Will promise them is that I've got 99% of my money in Berkshire, and most members of my family may not be quite that extreme, but they're close to it. And I do care about what happens to Berkshire over the long period, about as much as anybody could care about it. But caring doesn't guarantee results. It does guarantee attention.
So in summary, Buffett has basically told us invest in index funds, It is impossible to tell which individual business will succeed for many years. So holding the passively managed index funds such as the S&P 500 or the total stock market is the best for most people. That's the best an individual investor can do. And there is no evidence to show that index funds are bad. Rather, he says that active managers are known to want to make sales and sales commissions on the expense of individual investors, and thus there is a conflict of interest, which is why they speak badly about passively investing your money. If you want to invest in index funds such as the S&P 500, which Buffett keeps mentioning over and over again, here are the fund tickers that I advise you to look into. And I will limit myself to ETFs, but you can also use the mutual fund equivalents or the Admiral shares, what have you. So for an S&P 500 fund, you can look at the Vanguard's VOO ETF. And as an alternative, you can also look into the total US stock market. My recommendation for that is to buy the VTI ETF, also offered by Vanguard. The return of both of those funds are virtually the same. It's just that VTI has a broader set of companies bundled into that index. It has all the S&P 500 companies plus a couple of thousand more. So essentially, you're getting even a better diversification. And for my non-US audience here, you can also buy the S&P 500, but the funds I mentioned above are not necessarily suitable for you, or they may not be accessible to you. You can pick out funds which are domiciled in Ireland. So for example, Vanguard has an S&P 500 fund, and the ticker is VUSD. That's also an ETF. Or you can go with iShares, and they have a CSPX ETF. That also follows the S&P 500 index. Now, if you want to own not simply a cross-section of America, but own the whole global market, you can buy the Vanguard VWRD ETF or the iShares equivalent SWDA. Both of those are really good. They're equally good. The Vanguard one has a little bit of emerging markets, but don't worry about that too much. Both are very, very good funds. And both of those are offered as accumulating and distributing versions. So pick the one that you like. Also, you can buy them in various currencies. So you can really suit yourself and figure out which one fits you better. So thanks very much for watching, guys. I hope you enjoyed the video and appreciate the real investing advice. If you agree or disagree with Buffett's advice, we can continue the discussion in the comments. I'm really curious actually to hear what you thought about Buffett's speech. And if you like the video, by the way, please smash the like button so that people can find it on YouTube. To all the new subscribers, I want to say thank you. Thank you for subscribing and showing interest in the channel. I'm constantly working on new videos on investing in personal finance and putting all of those videos in specific playlists in a specific order, which I believe would make the most sense to you. So you can binge watch those if you want. So check those playlists out. I hope you have a wonderful day, and until next time, stay the course.